All right, guys, welcome back to the channel. Excited for today's video. Actually just purchased a new laptop. I think it's the Acer Swift X because I was noticing, and I had a couple comments on this and messages that when I was doing my other videos, there was almost like those old Japanese martial arts video where the speech didn't match the open mouth. I think there were some renderings on it was an older laptop. So we'll see if this is a better quality moving forward. Also have a nice, I think it's a 4K webcam. So we'll see on this new technology how it plays out. Um, but let's get right to it. In today's video, I want to do basically two things. The first is to showcase some of my composer symphonies and which ones are holding up the best in this market volatility. And the reason for that is we can learn intellectually kind of what's going on in the market, what's doing well, and then to kind of project maybe why it's doing well or why it's holding up fairly well in this big sell-off. And then the other thing is mentality in itself. You're going to see a lot of essays now from financial advisors and financial media on kind of how to deal with bear markets. You're going to see facts and figures on how long they last and how long the recovery takes, and just different facts and figures. What I'm going to talk about is a mentality that I've had that I've cultivated, which may be a little controversial to some, but it helps me get through periods like this. So let's get started. Let's start with alpaca to kind of show you where it is, and um, so we see here. Now let's go to the year. So my cost in is 153. Okay, so you can see here, this is the year, so this will be, I guess, January 1st. It peaked, it looked around December 27. Oh no, this is year, so it's going a year back. So this is December 27th, 28th, where it peaked around 155, just before the end of the year. I got a little bump. And I've said to a friend of mine, we're kind of with the Dow, in the overall market on this volatility on the path to nowhere in this 34 to 36,000 range. Now it's breached at 34, it's been in the 33s, but it kind of sells off, recovers, sells off, recovers. So we'll see how that plays out. Um, but then you can see the volatility and the big correction coming. So down to 130, 129 here today. So, down about 23 in this account. So that's where that stands. But let's actually get into kind of the nuts and bolts of some of the symphonies, and um, which ones are holding up. So you can see my cost basis on a lot of these is $2,000. And so I'm gonna look at the ones like kind of in the 19s. Obviously, a lot of the leverage ones have sold off. So we're gonna look at this one, 19. These two here, enhanced momentum, simple, and this is one actually from Composer. So right now it's in a bond fund. So let's click on it and see if we can glean some more information here. Yeah, and this has done its job. It's determined whether a market is risk on or risk off. If recent total bond market returns are higher than short-term bond market returns, the market is risk on. Otherwise, it is risk off. If the market is risk on, select the top momentum asset from a set of 3 ETFs and assign it with full weight. If risk off, assign the weight to long-term US government bonds. So obviously, it's determined it's risk off, so it's holding IEF, 7 to 10-year treasury bonds. And I mean, again, Composer is just like magic, man. I mean, like, could you be running this amount of symphonies, trying to look every day to track if BND is above BIL and then to shift off? And so this is the logic behind it, and they're going to be releasing a marketplace fairly soon where you can buy their symphonies as well as user created, like some that I've created. But this is one of theirs, even though it says it was created by me. This was one of theirs. Um, so I'm probably one of the first people to use their symphonies, my symphonies, on such a high level, like on a six-figure level. So that's really cool, that one, and it's done well. So let's just kind of keep going. Now, this is one that I've created, permanent store of wealth. I think it's this 4 ETF, right? This is that one. Yep. Okay. So this is what I call, you could call this your trust fund account, your lottery winnings account. Let's say you're generational wealth, or even if you're not generational wealth, but you have a lion's share of money. You started a business, you sold it, um, whatever, and you're saying to yourself, like, I want to kind of set it and forget it portfolio, that I don't have to think about. Now, there's always the traditional 60/40 that a lot of financial advisors are going to tell you about. There's the Warren Buffett 90/10. There's the Ray Dalio all weather. So there's different options out there. This is one that I've created, and I have my mom has an annuity, and I have something similar to this, and it's a 70/10/10/10. So it's 70 stocks, 10% bonds, which a lot of financial advisors would say that's not enough bonds. So be it. And then I feel that a lot of people don't really give attention to commodities and to real estate. So it's 10% commodities, 10% real estate. So this is like the four version of it. I believe I balance once a year, rebalance once a year. So it's VOO, VNQ, BND, DBC, and that's held up. So that's great to know. Like if you're having your your whole net worth, like this is something where if, let's say, in my will, I would say I want all of my money in this, in this sort of permanent store of wealth allocation, kind of like Warren Buffett has done. His is 90/10. His is 90% VOO, 10% short-term bonds. But we can just click on it here. So it's encouraging to see that that's held up quite nicely. And every year, yeah, so it's a once a year, 70/10/10/10. Pretty basic, pretty simple. So glad to see that that's doing well. So let's keep scrolling here. Um, okay. So this one is also a composer one, GTAA 13. Let's click on that. See what's going on here. It's got a lot of holdings. So let's actually like click into it and see what it is. So it says Global Tactical Asset Allocation 13. Wow, it sounds like something the Pentagon would release, right? Diversified strategy split between 13 categories: US large cap value, momentum, and momentum equities, US small cap value, European equities, emerging market equities, US intermediate and long term government bonds, international government bonds, US corporate bonds, commodities, gold, and real estate. Wow, that's a mouthful. With each category, asset performance is compared to the 200-day moving average. If it is worse, the corresponding weight is instead assigned to short-term U.S. government bonds. The strategy was originally developed by Meb Faber, so that's pretty cool that they've instituted something here. I've read his books, very sharp mind. Um, so very very cool that that's also done well. And let's continue down here. There's another one at 1945 monthly dividends. So this is one here, and these are what I call my laundry list symphonies. And so do you see like the Meb Faber one there on some of the other ones I've created and others, they're kind of logic based. Um, this is one where I just took a bunch of stocks that are paying monthly dividends. It's fairly comprehensive. I don't know if it's every single one, but it's a lot. And I just listed them and it's rebalanced once a year. And so you can see when you listen to financial media, CNBC, Bloomberg, people online, they're talking about this rotation into quality, this rotation into value, this rotation into dividend payers. So you can see here that these stocks that are paying monthly dividends, they've also held up quite well. I can just click on it real quick here, and you can see kind of the holdings. It's a laundry list of rebalance, yeah, every year. So there's 38 holdings in there: Agree Realty, AGNC, Broadmark Realty, EPR Properties, just going down here, Tal Bank, Gladstone, LTC, Main Street, so on and so forth. So there you go. So the monthly dividend. So that's telling you something there. Again, I'm trying to give you information what is held up to maybe kind of read the tea leaves a little bit as to what is unfolding. And we got another one, 1938. Again, dividend ETFs. Look at that. So now you're seeing, and this is a great point to make. One of the things that I do with investing, and Steve Cohen at SAC Capital also mentioned this, is I look for patterns. So you're seeing a pattern here, right? You're seeing dividend payers are holding up quite well in this market sell-off, whereas some of the more leverage long stuff, is struggling. So it's down a couple $100. It's not catastrophic, but it's not holding off. And here we go again. So just as we saw with the composer created symphony earlier, um, this is another risk on, risk off, and it's actually done its job. Let's see what it's holding. The other one was holding IEF, and this one is the same. Oh, I think actually I have a duplicate. I think this is the same one, just a different name. Let me just see here if it's the BNDBIL. Yeah. So I'm actually, yeah. So I'm actually running 4,000 on this one. So that's kind of cool. Sort of serendipitous accident that I had a copy and I'm running under a different name, and so it's running. Um, so yeah, this one is held up. Let's see. Let's just keep going down. Keep going down. Oop, see if we missed anything there. So just scrolling through. Here's another observation is I've noticed that with some of the risk on, risk off stuff, like this one is buy the dip Dow. The Dow has held up. Things holding the Dow, market timing or risk on, risk off, have held up much more than things holding the S&P and the Nasdaq. So you see two of them back to back here. Buy the dip Dow, Dow market timing, 1962, 1909. So they're also holding up. Now this one, daily profit harvesting. This is actually a good point to make also. Um, so this one has actually been running since June. The actual cost basis is $2,000, and it's actually up since June. And I said this to a friend, and I said, God, I wish Composer and Alpaca were around 2 years ago, because I would have had this big run up before this correction and sell off, and I would have had some leeway. Some of the accounts, I'll say it was 2,000, it might have been up to 3,000 or 3,500 each one before a pullback. And you can see that this one started running in June, so it got that full amount of time to run before the correction. And again, the cost basis is 2,000. It's just because when actually, I think when Composer went live, that was the value at the time. But it's actually, so it's up since June, which is not too much, but up a little bit. So that's also, and that's again because of that longer runway. Almost finished here. We got 1900 Warren Buffett legacy. Oh, that's what I mentioned earlier. That's the 90-10, 90% S&P 500 VOO, short-term bonds. So that's just sort of like Warren Buffett's legacy holding there. And 18. Oh, and this is an interesting one. This one right here, you can't see it because of my screen, is Canadian banks. It's actually up. The other ones were holding. I put it holding up well, meaning if the cost basis was 2,000, maybe they're at 1950, 1910, 1980. So they're almost flat or just down slightly. This one is actually up. And I feel that it's tied into the monthly dividends and the dividend ETF symphonies that are also up. In my value screens that I was looking at, and this was a while back, like maybe 4, 5, 6, 7 months ago, all of the big five Canadian banks were showing up in the value streams as number one, like on discounted free cash flow or the discounted cash flow model. Just all kinds of value screens. They were all pointing into the Canadian banks, and the Canadian banks are also great dividend payers. They pay 3, 4%. A lot of them. So I hold it. I hold in my TD account, and I just created again. This is what I would call like a laundry list uh, symphony. It's not something like Meb Faber, which is necessarily using logic and market timing. This is one. It's like I just want to hold these banks, rebalance them once a year. That's it. Very simple. But those are actually up. So that's an interesting observation. Again, I would put that with the idea of dividend ETFs holding up, the idea of monthly dividend payers holding up, kind of the chatter of the rotation from growth and Kathy Wood to value dividend. So we'll see, but it's again with Composer, I'm able to get this information because of all my holdings. Another one that's holding up real quick here is China, China, China. I think because that had sold off so much with Alibaba and other things, and then I purchased it. I think kind of like around the bottom, and it's just again that's kind of a laundry list symphony of China ETFs. We can click on it here. It's not anything necessarily based on like logic and in this out that. It's just a laundry list of different China ETFs rebalanced once a year. So let's get into the finish out here, with the second part of this video. And it's kind of how I've weathered Planex. Well, the first is doing deep research in market sell. So remember in 2020, and if you go back to my content, I was showing some of the books or my Instagram or even here. I tried to read every book on market crashes that I could get my hands on. And I did. So just understanding the history of market crashes, market panic, who suffers, who does well in those, the sort of a transfer of wealth. And so there's that. And then the other thing is mentality. It's having a mentality that's different from the masses here. And so when you see a lot of people write on market crashes, they're going to give you a lot of data, and that's great. They're going to say that this is to recover. But one of the things that's helped me is kind of having this sort of blue-blooded, aristocratic sensibility, even if it's opposed, even if it's manufactured. Okay, never kind of seeing yourself as in that sort of populist, us versus them, the rich, always kind of identifying with the rich, studying with how the rich have built wealth, as opposed to statements like, oh, it takes money to make money. Oh, the little guy always gets hurt in these things. Oh, it's only the fat cats that make money. These are all sort of populist tropes. And so looking at people like I just have two names up here. Bernard Baruch was a big mover and shaker on Wall Street in the 20s versus a Micro. Micro, very much a populist, kind of like no sort of echoing the cliche. No one wants to work anymore. So someone like Micro is going to kind of tell you like, listen, kid, set your alarm clock, get to your job, collect your W-2, be a good boy, be a good girl. Look to jobs that you may not thought you'd want to do growing up, but settle for a paycheck, settle for something that's going to support you. And so there's something to be said for that to a certain extent, I guess. But I've just never identified. Like whenever someone says, "Oh, but the average person or the average American," I always like cringe, like literally, like my body, like I cringe when I hear that. So it's avoiding sort of a populist, resentnik mentality. So, for example, this account that I just showed you right here is down 153 to 130. So that's down 23,000. My other TD in this sell-off is down about 100. So between those two, that's 130,000. If you have like a workaday mentality, you might say things like, no one handed me anything, I'm self-made. That 130,000 I had to work like this many years to get it, and you're too tight with it. Actually it's funny. The guy Boris Berevsky, the Russian oligarch who committed suicide in London, talked about this. People that oftentimes are too tight and too, like penny pinchers and can't take any kind of hit, oftentimes struggle and don't make the right decisions. Or if you see yourself having lots of buckets, so like for me, studying Grant Cardone and Robert Kiyosaki, I have a couple million in real estate that is throwing off cash. I have crypto, precious metals, what Kiyosaki would derisively call paper. He would view this as paper, right? Stocks and bonds. Even looking to diversify into businesses. Just had a meeting yesterday about a pizzeria. So just having like multiple buckets, passive income, not identifying, not getting like bitter and resent nicking against those who are doing well, against volatility. So that's just something that's helped me. And again, that might be controversial. Someone might watch this and like, who the hell do you think you are? Or that's arrogant, or it's classist, or whatever the angle that you want to attack me on. But it's a mentality that I've had that has helped me through volatility. It helped me through volatility in 2020, and in this and that. I'm looking at this as an opportunist, looking to find sectors, things that are struggling. Where's the wealth being transferred to? How can I, take a step back to take 10 steps forward? Like you'll see here, and I always show this. Okay, for those of you who watch channel, this graphic is going to be repetitive, but it's instructive. Again, panic of 2020, 359, 203, 100 and some thousand. But I was buying airlines. I was buying cruise lines. I was buying hospitality. I was buying energy. I was buying banks. Lo and behold, shoo, there we go. Now look, even this little panic, look at the difference here, versus here, 670 was the peak. It's a smaller dip than something like this. So it's, in 10 years, will this even be visible on the screen? That's another thing to look at. When you look at the Dow or the S&P, the Nasdaq over like 50 years, 100 years, some things like 1999, 2008, they're like little divots. You can hardly even notice them. So taking that kind of step back and that long view is helpful. But listen, guys, that's pretty much it for today. A little longer video, but wanted to really showcase, in Composer, what's holding up, what's doing okay, and then just talking about a mentality of not kind of a woe is me and too much of a kind of micro W-2 mentality, having more of the mentality of capital versus labor. So there it is for today. Take care. Ciao.